I see the U.S. economy as being really remarkably strong compared to where I thought it would be after this many interest rate rises. I don't think credit for that is due to the Fed. I think it's due to the American people.
Yeah.
I think the American people, by and large, are industrious, kind, and hardworking. I don't think it was the Fed that assembled a group of young people around a garage in Sunnyvale, California, that created Apple or created Google or created all those other wonderful engines of the U.S. economy. But I'm impressed by the relative strength of the U.S. economy. It's doing much better than I thought it would. My fear, of course, is that
financial expert Rick Rule provides a unique perspective on the U.S. economy amidst rising interest rates. He credits the strength of the economy to the industrious spirit of the American people, referencing tech giants like Apple and Google as prime examples. Despite initial concerns, Rule acknowledges the surprising resilience of the economy. However, he warns of potential challenges ahead, particularly concerning housing affordability and the drying up of credit for lower-grade borrowers. Moreover, he delves into the stagnation of real wages and its impact on consumer purchasing power, hinting at an imminent shift in consumer price levels. As Rule navigates through these complex economic factors, his insights leave us questioning the future landscape of the U.S. economy. Stay tuned for the latter part of his analysis, where he unveils crucial details about the impending changes that could reshape the financial landscape.
The impact of higher interest rates and the impact of tighter credit markets is a lagging effect, and that we'll feel it later rather than sooner. But that's an editorial. You asked me about the strength of the economy, and I need to say that the economy is in much better shape than I had anticipated it being in as a consequence of the increase in interest rates. I note, as an example, that new home sales and even sales of existing homes in some markets has slowed down as affordability around the 30-year fixed mortgage has decreased. The sellers apparently believe their house is worth what it was worth when the interest rates were less high. The buyers don't seem to be able to afford at higher interest rates those prices. So what you're seeing, rather than a move in price, is a move in volume down. Those moves in volume down in markets, in my own experience, do result in a change in pricing, usually lower. Mm-hmm. We'll see if that occurs. I think a bigger problem that we need to be concerned about, both as investors but also as consumers, is the increasing unavailability and unaffordability of credit to below investment grade borrowers. Mm-hmm. Private businesses in the country, real estate developers, even public companies that have to access the junk bond market. If we see a real disintermediation in credit, a risk-off in credit, then I think perhaps you see the type of outcome that we've all been afraid of. I'm not saying it's going to occur, but when I look at things that keep me awake at night, the increasing illiquidity in credit markets below investment grade probably is at the top of the list. I am noting that the availability of credit below investment grade seems to be drying up. And I note, too, the increasing levels of consumer debt at credit card revolving interest rates, which is to say, when you talk about a prime rate in the 6+ range, most people are borrowing at the 20% range. And I think that probably becomes increasingly unaffordable. I note, too, this is either good or bad depending on who you are, that workers that have economic clout, which is to say workers that have the skills for the organization to demand higher wages, are beginning to become fairly intractable. Many of them haven't gotten a real pay raise, that is to say a pay raise in real terms, for 20 years, and no pay raise at all for 4 years. And if you've received no pay raise at all for 4 years, if you believe, like I believe, that the real rate of the deterioration of your purchasing power is at 7% plus compounding, what you're doing is seeing your living standards decline in real time. Mm-hmm. The first half of the decade of the 70s was what you might call demand pull inflation. The second half was cost push inflation, which was a consequence of the higher wage settlements that occurred in the time period 1976 to 1981. And I look as an example at the job action by the United Auto Workers.
Yep.
But more particularly by what you see in the economy, where skilled workers or workers whose utility is high are demanding and getting much better wages than they have in the past. I'm not saying this is a bad thing, but I am saying that it will likely manifest itself in consumer price levels for the next couple of years.
In this next discussion, Rick Rule delves into the current state of the U.S. economy amidst rising interest rates. Rule credits the robust economy to the American people's industrious spirit, pointing out remarkable examples like Apple and Google. While expressing initial concerns, he acknowledges the economy's unexpected resilience. However, he warns of challenges ahead, particularly in housing affordability and the drying up of credit for lower-grade borrowers. Rule discusses the potential scenarios regarding interest rates, speculating that either economic activity will slow down or rates will increase. He emphasizes the strength of major companies like Schering-Plough, Procter & Gamble, McDonald's, and ExxonMobil, believing their credit quality will endure despite possible share price declines. However, Rule's major concern lies in the proliferation of high-yield junk debt ETFs. He fears a scenario where investor confidence wanes, triggering mass redemptions and subsequent illiquid asset liquidation, akin to a bank run on an unregulated and illiquid bank. This, he believes, could be a potential black swan event, emphasizing the need for a highly liquid portfolio in preparation for such uncertainties.
Well, I don't suspect that rates will be able to be maintained at 5 or 6%. I suspect you'll have a situation where either economic activity slows down and demand for credit slows down, or the rates go up. Remember, not too long ago, rates were set by the market.
Yeah.
I remember President Clinton saying that in the afterlife, he wanted to come back as the bond market, which had more power than any other entity on earth. There was a fear in the early days of the Clinton administration that the Fed would give a treasury auction and nobody would show up. The Fed would have to buy their own auction. I don't think we're at that level yet. And I need to say that the biggest and best companies in the American economy, while I believe them to be at least fully priced in terms of their equity prices, are very stout, very solvent businesses. And I suspect in an environment where there is a concern about credit quality, that you will see continued disintermediation from the non-investment grade companies to the investment grade companies. I don't think that you are going to see economic difficulties among the Schering-Ploughs and the Procter & Gambles and the McDonald's and the ExxonMobils in U.S. markets. You might see the share prices decline, but I don't think that you're going to see a decline in credit quality or credit availability to those companies. If you want an event that keeps me awake at night, and I hate making audiences scared, but the economic event that really keeps me awake at night is the proliferation of high-yield junk debt ETFs, where investors who aren't willing or able to do the arithmetic as well as some of us chase yields. And they buy these extremely liquid ETFs, which invest the proceeds in very illiquid high-yield bonds. If you have a reduction in the confidence of investors and they begin to redeem those high-yield ETFs because of their concerns over credit quality, the redemptions trigger the liquidation of an illiquid asset class beneath the very liquid asset class. I've made jokes in recent interviews stemming from my youth when I talk about illiquid assets, illiquid markets in high-yield bonds as generating an asset class called owl bonds. An owl bond is where the portfolio manager calls the broker to sell some bonds, and the broker says, "Too-hoo." The result of that, because there's several $1 trillion in that asset class, could be a bank run on an unregulated and illiquid bank. Really want to see something on the horizon that to me feels like a potential black swan.
Yeah.
That's the ugliest one that I see out there. I
Yeah.
want to hasten to say I'm a credit analyst. I'm not saying this is going to happen. But the thing that really makes me keep my portfolio highly liquid is the possibility that that could happen and the consequence of its aftermath.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.